This housing market isn't crashing, despite the media's subtle prediction of a housing crash as bad as 2008. And these 4 squares will explain why this is all sensationalized clickbait and what you should actually do if you want to buy a house. 77% of home buyers believe that we're in a bubble because mortgage rates more than doubled since 2021, and now there's a ton of buyers, including me, crying on the sidelines thinking that a 2008 level crash is on its way. But then why are median house prices actually up 7.5% year over year? If we actually zoom out, sure, housing prices are down a couple of percentage points from all-time highs, but it's still miles and miles away from the 33% crash we saw in 2008. So I went ahead and did some digging, and I discovered the first square, housing demand. Look, it's no secret that now houses cost a ton more money overall. Now, the math is complicated, but Mr. Magic Lamp can explain. So, Mr. Magic Lamp is looking to buy a house in the great state of Indiana. Now, he did come across one that he really likes for about $200,000, and unfortunately, he doesn't have that much money in hand, so he has to go to a bank for a loan. Now, the bank that he goes to offers 2 types of 30-year fixed-rate mortgages. Now, Mortgage A offers a 3% interest rate, whereas Mortgage B offers a 6% interest rate. So, if Mr. Magic Lamp decides to go with Mortgage A, then he's going to end up paying around $300,000 in total over the lifespan of this mortgage. However, if Mr. Magic Lamp goes with Mortgage B, then he's going to have to pay around $431,000 in total, which mathematically speaking isn't the best thing because that's about $125,000 plus more for the same exact house. And this, ladies and gents, is where the problem lies, that he wants to live in Indiana. So potential buyers like you and me are experiencing massive FOMO right now after seeing such a large price increase, especially after realizing how much cheaper it was to borrow money just a couple of months ago. So the question remains, what can you do now? Because of this sudden rise in interest rates, over 18 million households were priced out of $400,000 plus mortgages, resulting in mortgage demand to fall to its lowest level since 1997. Now, I'm not saying we won't see housing prices drop in the near future, but I don't think we're gonna see a 2008 level crash because, well, there's 3 more squares. So the second square goes with demand just like Cheez-Its and Sriracha. Supply. So if you want to watch the world burn just so you can buy a house cheaply, then you need super low demand and super high supply. And what's actually happening is probably the last thing you'd expect. Come on. All right, so let's say our great friend Mr. Magic Lamp actually ended up buying his $200,000 house in the great state of Indiana with his really fantastic mortgage rate of 3% and total cost of this. And now 2 minutes after buying the house, he's wondering if he should actually sell his house because Mr. Magic Lamp is just an indecisive piece of rock. If he does end up divorcing his house right now, then chances are he's gonna have to buy another house, which really isn't gonna be the smartest move right now. But let's say he does find another house for the same price of $200,000. However, the scenario now is that bank only offers about 1 mortgage rate at 6%, meaning that the entire total would still be $430,000. So what this means is that if he ends up selling his original house, then he'd have to give up the lower, better mortgage rate in exchange for the much higher, worse interest rate. So chances are he's probably not going to sell his house, which is exactly why a lot of sellers do not want to sell their houses right now, which really limits the housing supply. So what does all this gibberish mean? Essentially, if we look at a supply and demand curve where the price is over here and quantity is over here, we're going to see some really interesting information. First, we know that housing demand is decreasing because of increasing interest rates, which means that this demand curve actually moves down over here, which looks like the price should actually be going down. But we can't forget that actually housing supply is also really tight right now, which means that supply has to go up here, which maintains the high price point for houses. But that doesn't mean that no one is selling their houses. Actually, if you look at the data, you can see that number of new home sales is actually up 3% year over year. Now, that isn't a huge growth number, especially compared to pre-pandemic levels, but it does indicate that something is fishy going on. So be sure to keep this in mind because we're going to be talking about this a little bit later and it's going to change everything. But for now, what's even more interesting is going to be this metric, monthly supply, which indicates how long it would theoretically take every home that's currently on the market to sell based on the current home selling activity. Sorry, I didn't eat yet. The calculation is total houses currently for sale divided by the current pace of sale. So if there's 6 houses for sale and about 1 house sells per month, then it would theoretically take 6 months to sell all the houses. Now 6 is considered a housing market that's pretty balanced. Anything above is considered a buyer's market and anything below that number is a seller's market. And right now we're at 2. So we are in a seller's market, meaning that there are more buyers than sellers, which is the opposite of what leads to a housing crash. But we're still missing 2 more squares, and these are the things that put the final nail in the coffin and completely obliterated the 2008 housing market. The third square is mortgage type. If we go back in time, most of the mortgages that were issued in 2008 were these things called adjustable rate mortgages, which basically means that the interest rate you can get charged on can go up or down every so often, which was very risky because if your monthly payments all of a sudden increase substantially, then there's a chance that you probably couldn't pay off your monthly debt. However, most mortgages nowadays are fixed, meaning that you're charged the same interest throughout the entire life of the mortgage. And luckily for those who recently purchased a home or refinanced, they got locked into a rate that's lower than my standards. The fourth square is quality. So back in 2008, these things called subprime mortgages were hotter than chia pets. Subprime mortgages are essentially bad loans that's given to bad borrowers because they have bad credit. And in exchange for the lenders taking on more risk, the borrowers were charged a higher interest rate. But this caused a huge problem, especially when people's adjustable rate mortgages increased. You see, lenders were really chill back then. Practically everyone was able to buy a house, which severely inflated the housing market. So when it popped and people couldn't afford their debt payments anymore, more than 3.1 million homes were foreclosed on in 2008 alone. In foreclosure basically means that the borrower couldn't pay their loan back to the bank, and the bank takes control of the house and tries to sell it on the market to recoup their losses. And this essentially meant 3.1 million homes went on sale during this time, completely flooding the housing supply. And because there were significantly more supply than demand, housing prices crashed harder than the newest Thor movie. Actually, so I'm looking at the data right now, and the pattern might be repeating itself. Foreclosures for the first 6 months of 2022 are actually up 219% year over year, which means there's a ton more excess supply. Just kidding, it's completely different this time. You see, banks sort of learned their lesson from 2008, and now they're a lot more strict on who they can lend to, which ensures that borrowers can actually afford what they're buying. And yes, the 219% number does seem very scary, but that's only about 117,383 foreclosures for the first half of 2022, which is very far off from the millions of foreclosures that we saw in 2008. Plus, the jump in numbers that we see today is because of a backlog of foreclosures from before the pandemic. You see, most of these loans were already in foreclosure or were more than 120 days delinquent. And the data shows that there are actually very few defaults on recently purchased homes. Remember, the US government put a foreclosure moratorium in place so that it was harder for people to foreclose on stuff. And because there were so few foreclosures in 2021, a sudden uptick makes the percentage seem very high. But the truth is, overall foreclosure activity is still significantly below historic averages. But that's not to say that the housing market isn't clear yet, because there are still 2 red flags brewing that could trigger a bigger price drop. So remember when I said that there's actually something fishy going on that's leading to an increase in housing supply? Well, the supply increase is not really from what we call existing homes. You see, there are 2 main house supply categories: existing home and new homes. Existing homes means that there's a current owner who lives in the house and is selling it. On the other hand, new homes are usually sold by big companies and home builders, and they're not really having a great time right now. Because the demand for housing is lower thanks to the higher mortgage rates, supply of new homes in the market has increased to the highest level since 2008 for one reason. New home builders don't want to hold on to their inventory for too long because it costs them money. Instead, they're incentivized to sell them as quickly as possible to make a profit. And since there's less demand for houses across the board, new home builders have to lower their prices to sell. In August, about 19% of new home builders said they had to reduce their prices to sell their new homes. In September, it was 24%. And we can only expect this number to continue to increase because the Home Builder Confidence Index, which essentially shows how confident these new home builders are in their home sales, continue to drop. And now that I'm thinking about it, depending on where these new homes are actually located and whether they're tightly concentrated in a specific area or not, they could start dragging down the comparable sales of new and existing homes in the surrounding areas, thus leading to lower prices overall. But there is one more red flag at play. To no one's surprise, inflation reached another record high, and the Fed just raised rates again, which will decrease demand further. However, so far the decrease in demand isn't really that substantial, but that could change in the next few months because some analysts are expecting a mortgage rates to increase to over 10% in 2023, which is terrifying because these are levels that we haven't seen since 1989. So the question remains, What should you do if you're looking to buy a house?
So like many of you, I'm also looking to buy real estate. And what's really embarrassing to admit is that I actually made a huge mistake 2 years ago. You see, I actually started looking for real estate literally right when the pandemic became a big deal in the US. See, I built my real estate calculator in April 2020. And in retrospect, the timing was absolutely perfect to start because this was before house prices started going up and interest rates were still super low at the time. But then I stopped because I ignorantly thought that prices were gonna go lower. So I waited and I waited. You see, there are a few levers at play that could cause the housing market to drop over the next couple of months, but just based off of today's national data, I highly doubt that a 2008 level crash will come. Now, this doesn't mean that a crash is for sure not going to be coming, but based on the national data right now, it doesn't really support that theory. So if you're in the market like me, then you might want to start looking into the new homes category. Supply is increasing there and builders are consistently cutting prices to start getting rid of that inventory. But I will say that none of this would really matter if the Fed succeeds with its plan to sacrifice the middle class to make the rich richer. Watch this to find out what's happening, and it's pretty terrifying because it could happen in the next 12 months.